kind of a rally. But there you go, straight away, 22,268. This is above last Wednesday's high. Yesterday, the market did get above Wednesday's high intraday, but closed under it. But this morning, we are starting above it once again. So 40 points. So, a little bit of a cool off. But this is a decent start after the furious rally from the day's low that we had yesterday. The Nifty Bank is up about 0.15%, 75 points higher. We're at 47,000 there. And you got the mid-cap index, which starts about 0.5% higher as well. So all told, decent start, at least on the indices. But Sonia's got more rates. Sonia.
Oh, absolutely. It's a good start on the indices, as you rightly pointed out. The Nifty looking pretty good at that 22,200 mark. Let's take it straight to the Bank Nifty, right? That's holding on with gains of around 50 odd points. Now, yesterday, the Grasim was the big mover. So there could be some follow-on buying on Grasim this morning as well. A lot of brokerages continue to be bullish over there. Grasim up 1.5%, putting on some more weight even on the volume front. Now, Asian Paints was a bit under pressure because of, that large launch in the paint space from Grasim. Asian Paints down 1%. Jefferies maintains an underperform on Asian Paints. They have a target price of 2,500, which is well below the current market price. So maybe you could see some more pressure on Asian Paints. Yesterday, we saw auto stocks rally in late trade. Bajaj, Eicher Motors, M&M. Would be interesting to see if there's any follow-on buying. There is an Eicher Motors, and M&M as well has been a stock that has been on a tear, but today it's just about open absolutely flat. Would be interesting to see what's happening with PSU banks like SBI, because this morning, Goldman Sachs has downgraded SBI to a neutral. They have a target price of 740 on the stock. There's a little bit of pressure on SBI, not too much. But is the run done on PSU banks? You'll have to wait and watch for that. Apart from that, Vodafone Idea will be considering a fundraising proposal on the 27th of February. That stock has been moving higher day after day. Today, it's up about 5.5%. So don't lose sight of that. Angel One is also in focus. It will be raising 2,000 crores via a preferential issue. So that stock is up in the green, 2% higher. Honasa Consumer in focus as Citi has initiated buy. They have raised their target price at 550 rupees a share, which is above the current market price. So 3.5% higher on Honasa Consumer. And GMDC is the other one I'm looking at. The board has approved a capital outlay of 3,040 crores in FY25. So GMDC also on your radar. But the Nifty, by the way, has opened at a fresh record high. So if you're thinking the party is over, it's not done just yet. Slow and steady to new highs, and something that is seeing contribution from the Bank Nifty this morning, up about 30 odd points. Back to you.
Okay, all right. Thanks a lot for that, Sonia. Well, Vodafone Idea is going to be raising money. The street is optimistic about that. If Vodafone survives, then Indus Towers gets the required money as well. So that one's up close to around 3.5%. Both of them bucking the trend this morning. You have Intellect Design, actually. That stock is up close to around 2.5% as we speak. So big uptick is what we're seeing on that one. ABB, splendid run. In this week so far, it's up close to around 18%. That stock, though, is pulling back close to around 1.5% in today's trading session. So keep an eye out on that one. Other couple of stocks that are on focus, you have RVNL, IRCON, both of them up 3.5%. And Geo Financial Services, don't lose sight of that one. It's moving, and it's moving very, very well. In this month itself, it's up, I think, close to around 25%. Big up move is what we're saying. Out there. Remember, it's got shares of Reliance Industries, and Reliance Industries itself has done so well. So that one, in fact, is playing a bit of a catch-up out there. Majority of the share value as of now comes in from Reliance, so keep an eye out on that. Pull up HDFC Bank. Just want to make a quick point out here. Reliance Industries is moving in terms of weightage towards HDFC Bank. We had highlighted this a couple of weeks ago as well. And now the gap has narrowed to around 0.65%. A few months ago, it was close to around 4% in terms of weightage between HDFC Bank and Reliance Industries. So that's an interesting battle that's taking place. A couple of notable movers from the broader markets. IRDA, the stock went dancing away to around 215. We saw a couple of large trades at around this 160 odd mark. For today's session, it's at lower circuit, down 5% as we speak. Prashant.
Absolutely. It's a good start, right? I mean, can't complain at all. 40 points on top of what we saw yesterday. So 22,260. That's actually a good thing. You don't want 150 point higher starts. You want slow and steady. Actually, the ideal thing is for the market to actually start slightly lower, or at least give you a dip at some point and then move higher. I mean, that's the hallmark of a strong market. For now, we are up 40 odd points, which is slightly marginally higher. Now, Geo Finance is up 3.5%. It's the top volume traded stock right now. 313 on Geo Financial Services is what we have. Indus Towers, which we highlighted earlier, Nigel was talking about that, 4% higher at this point in time. It's the second largest volume traded name. RBL Bank is up 1.8%, 271. We highlighted RBL Bank with one of the large investors picking up additional shares in that. Graphite and HEG have been doing well. I can spot Graphite with a 1% pop this morning. The ports company, JSW Infrastructure, is up 1.25%. Stocks at 247. That is JSW Infra. There is South Indian Bank, which continues to, it's having a great last couple of weeks or so. South Indian Bank has got, is almost at about 37 rupees now. That's a big one. You know, there's one stock called Tarmat. I'm not sure, 18%. I think it came up last couple of days as well. I'm not sure what's happening here. So 20th of February, the close was 80 bucks. It's at 130 rupees now. And today is the third day in this journey. There you go. That's the one. Look at the volumes there. 2.3 million shares. And that's the reason we are sort of highlighting that this morning. That's a big mover.
I think it's a small market cap though, Prashant. 250 crores. You know, even after this move is what we're seeing.
I mean, it's never come up on our, when we've, I think it's not never come up, period. But, it's coming up with volume, so it's popping up here. Very large move once again here on this one. You got India Cement, which is up. I mean, rest is routine. Nothing very large at all. On the downside, let me just take a quick look if there's anything else. Irida is down 5%. I think we did mention that. Devyani is starting with about a 2% cut. So that's at about 161. And Fact is down 3%. That's Fertilizer and Travancore. That's coming up with a bit of a loss. Medanta is another one, another hospital name, which is down about 2.5%. Orient Cement is down 5%, but it doesn't have too much volume. So maybe keep an eye, but not to focus too much on it right now. So that's the market for you.
Just a couple of notable movers, Prashant. Nimesh is highlighting us with regard to that FTSE rejig that we saw.
Yeah.
Gokuldas was added, so that one is up close to around 7%. That could explain that. And also, I think, Fact, they've rolled back the addition out there. So that's why that stock is under some pressure. It's down close to around 3% as we speak. And Orient Cement as well, you mentioned that it was down. The addition has been rolled back for them. So Orient Cement as well as Relicare, both of them could be seeing some bit of selling because of this FTSE rejig that has come. The note has come out earlier today.
I was looking for Tarmat also in that list. That's a big mover as far as these changes are concerned. Gokuldas, of course, I mean, out of the ones we mentioned, is the largest sort of name, well owned as well, and that's seeing the most substantial move. That's the FTSE changes which Nimesh had been highlighting earlier. Let's welcome in Rupal Agarwal. She's joining us right now. She of course, is Senior Research Analyst, Asia Quantitative Strategy at Bernstein. Rupal, good to have you with us here. Thanks very much for your time. So let's just start by talking about quants. And, there is no real direct play on what's happening with NVIDIA and the big AI boom in the US. But maybe we could look at correlations. I'm not sure if you've kind of looked at that. But somebody earlier, a guest 2 days back, was highlighting that, US tech, and especially these large 5 or 7 names which are seen as a play on tech, India stocks and Japan, these are, highly correlated over the last 1 year or so. On the quant side, have you kind of looked at this? Any thoughts at all?
Yes, so we have looked at it not specifically from a tech perspective, but overall the kind of correlation that we are seeing with Indian markets versus US markets has been very, very tight in the last 3 years. It's not just, since the beginning of this AI rally. Japan, of course, there is a direct sort of correlation. Because Japan semis is something which is undergoing this massive geopolitical support system that is being built up, and hence any kind of positivity around NVIDIA results will always have this massive boom for Japan. So there is and I think the other way to look at it is whenever tech names, which is largely your proxy of a risk-on rally in US, when that happens, we do see most of the international equities doing well. And then because India and Japan have been those two favorite markets across Asia, we do see more of a momentum building up in these markets.
Okay, by the way, it's a good screen actually. The mid-cap index is up almost about 0.5%. And if you're wondering, from the frontliners, Reliance is at a fresh record high this morning. So don't lose sight of that. ICICI Bank is at a fresh 52-week high as well. Reliance is now just shy of the 3,000 mark. It's been a very strong run. This year already Reliance has put in 15% weight. DLF is at a fresh 52-week high as well. And a couple of other names. HCL Tech is at a fresh record high, so looking pretty good. A fresh 52-week high, that is. It's looking pretty good. Rupal, hi, good morning. I was going through your strategy note, and you say that you find only limited opportunities within the PSU portfolio. Can you elaborate on that? Because PSUs have been the big thing, right, in the last fortnight, in the last couple of months, rather. Your thoughts on whether there is more to go? Would you start to get a bit cautious here?
Yeah, so I think PSUs, of course, have taken up a lot of mind share. Investor money flow has happened, in these pockets. My sense is there are, yes, only limited opportunities left now. I would become more cautious towards, these names which have been very high proxies of high beta. Which sits a lot in this PSU, basket. So that's where we think vulnerability are building up. But we are okay to actually still get into names which are, say, providing high dividend yield. That would be the limited opportunity set where we are comfortable adding at these levels. Most of the other, areas, and I would say large part of them will be more in the PSU banks and industrial space. That's where valuations are quite stretched. And we are seeing that there's nothing been but a proxy of chasing the very strong momentum in the market, or in fact, being completely risk on. And that's something that I'm not very comfortable chasing at these levels.
Okay, all right. Hi, Rupal. Good morning. Good to see you, Ben. So industrials, well, they're trading at a bit of a premium, but PSU banks, maybe they offer some more value. Rupal, I wanted to ask you about the Indian markets on the whole. We have been thumping the table, earnings growth over here, political stability as well. And we're going to be having another election, which in all probability will have continuity that takes place. How much of the good news is in the price, though, at these levels of around 22,300 on the index itself?
I would say a large part of it is in the prices. That's been one of the reasons we've been relatively more cautious around Indian equity since the beginning of the year. I think, the domestic flow is definitely strong. The sticky SIP flow keeps on supporting the market. But I do think that, for foreigners to come back meaningfully, we need to see valuation, coming down. And if we look at year to date, they've not been very comfortable adding at these levels. So I do think that, yes, a lot of this, positivity around India, whether it's political stability or whether it's earnings, a lot is in the prices already.
Okay, a lot is in the price already. So where do you see opportunity now? I mean, are there any spaces where you think that there could be both growth potential as well as some valuation upside?
See, we've been arguing to rotate within the market more towards your larger names, more towards your quality names. And, in the recent PSU note, for example, we've highlighted that, looking at specifically chasing the value rally, I would be more comfortable doing that through, say, the dividend yielding names. So those would be the kind of pockets to look for opportunities right now. It's not that there are no opportunities, but they are limited again. But I think that needs to be the big rotation in the market because, last year there was everything pretty much was doing well, but parts of the market were largely led by this, very strong junk rally that happened in India. We saw, of course, a big momentum, sort of push. And a lot of that is looking slightly more pricey and toppish at this point.
Okay, it's looking pricey and toppish at this point. So you're saying rotate into large cap names, rotate into quality names, and dividend yield stocks is something that you like. Got it. What do you do with some of the large cap private sector banks? Because now suddenly buying has started over there. Delivery based buying has picked up quite a bit, but HDFC Bank and the likes, what are your thoughts there? Is this a good time to be buying?
See, I can't comment on any particular name per se, but if I have to compare, the analysis that we've done, for example, on PSU banks versus, so I can say that given that most of the PSU banks don't look very attractive, that does mean that we could start see, some interest coming back on the private side. Even if I look at from purely style perspective, the private banks would be, I would say they're not in our buy list right now, but they're not in our sell list as well. So they're very moderately positioned across the multiple styles that we track. So I'm okay with adding more on the private banks.
All right. The problem, I think, Rupal, is that the PSU banks, many of them are underowned by the mutual fund industry, while on the private banks, they are topped out. And then they've gone through this painful last 6 to around 12 months or so. I guess that would be the technical factors at play as well. But Rupal, I recall when we chatted the last time, we were talking about China and how China was bombed out. And from those levels, maybe in fact, that could be some kind of a rebound. Now, post the new year, there have been signs that maybe in fact, there are measures being taken both by the government, by the regulators out there to bring some stability. What is your view on that market?
Yes, so, the last time that we spoke, I did mention that we are expecting a tactical rebound in China. Things are moving more positively there now. If you look at some of the recent data that has come out of the, Chinese New Year, we have seen, big move up in the travel data. There's, of course, a lot of policy measures which are being implemented. Investor sentiment is improving. So we are seeing some, sort of positivity building up in the market. It's too soon to say that whether it's going to be a big move where we start seeing too much positivity from investor perspective. I think most investors are taking it very slow, and that's likely to play out in the near term. But I think directionally we are expecting the markets to continue to be more on that upward trajectory from here.
I know, got that absolutely. So, one of the sort of broad kind of this is slightly pulling back a little bit, Rupal. The consensus seems to be that the only thing working against India, right, the market here is valuations. Otherwise, and that maybe calls for a bit of consolidation till earnings catch up and numbers on the PE front, etc., come off a little bit. Otherwise, I mean, things look pretty set for the next few years. Is that your broad thesis at Bernstein as well?
Yes, valuations definitely are, I would say, one of the biggest bottlenecks for, I would say, more for global investors to really add or keep on adding at these levels in India. Even in our framework, valuations does stand out, quite stretched with respect to both its own history and, versus the premium that it typically trades to other markets. But I think at the same time, there are a few other factors. I would say earnings revisions or upgrades have actually peaked in India. So if we don't start seeing again a revival of that upgrade cycle, then it becomes difficult. The third thing would be, the kind of rate cut environment that actually the markets are already pricing in. So Indian market is already pricing in 6.3% 10-year bond yields. I don't foresee that happening in the near term. So that to me also remains one key risk, in the market. And then, of course, it's more about the flow, right? So the domestic flow will provide a support or a flow to the market. But unless we start seeing major comeback of foreigners, it becomes difficult to move, quite strongly. So I think those would be the other important factors to consider apart from, just valuations.
All right. Thanks a lot for that, Rupal. Appreciate your time here on CNBC TV18. That's Bernstein. A bit cautious on the market, actually, saying that there's not too much by way of valuation upside, and they prefer to stick to large cap names, stick to quality names, and dividend yield stocks is something that they're looking at. Well, the market is not, the market is actually throwing wind to the caution at the moment. Nifty is doing okay. It's doing well, holding on to its gains from yesterday. The mid caps are really picking up pace. But Goldman Sachs has come up with their call on financials, and let's find out what they're saying. Abhishek has more details on that. Abhishek, over to you.
Goldman Sachs has come out with a report on Indian financials, and they have downgraded many banks in their note as well. They believe that Goldilocks period is over in the near term as headwinds are now increasing for the banking sector. So the headwinds include rising pressure on cost of funds, structural change in the funding environment that they are seeing, growing concerns on rising consumer leverage. There is potential asset quality challenge that particularly in the unsecured loans that they are worried about, pressure on operating costs on account of the fact that wage inflation is on the higher side, and then they believe that banks need to expand distribution network for future deposit growth as well. However, in terms of sector valuation, it's been at comfortable level according to them. So Goldman Sachs has downgraded rating on SBI to neutral, ICICI Bank again to neutral, and Yes Bank they have downgraded to sell. In terms of upgrade, they have upgraded Bajaj Finance to neutral, and on SDFC Bank they retain their buy recommendation. Back to you.
All right, thanks a lot for that. In fact, Rahul Jain, who's the co-head of Asia Financials and head of India Research, Global Investment Research at Goldman Sachs, is with us to talk more about that. Rahul, thanks a lot for joining us. I know the run-up has been pretty sharp, right? And many of these banks, especially the PSU banks like SBI, is that your biggest concern, the lack of valuation upside? And take us through what the rationale is over the next 12 to 18 months, specifically for PSUs.
Thank you, Sonia, and great to be on your show. I think a couple of factors that we have laid out in our report, three areas where we think the earnings are going to be facing the headwinds. Number one is, of course, the funding environment. Deposit growth is facing challenges from multiple quarters, and that's going to put upward pressure on the cost of funds. You've already seen the funding cost take a U-turn over the last couple of months. And given the fact that the rise of alternatives is giving a challenge to deposit growth, and the loan-to-deposit ratio is elevated, the banks will need to keep increasing the deposit cost over the coming quarters. Number one. Number two, if you see the credit cost, it has been a very strong and benign environment over the last many quarters. We think that that's kind of starting to bottom out. And the area where we are concerned about the most is unsecured loans. We have been writing about this to our investors that this space is overheating. RBI also took some steps around it. And we believe that this area is going to perhaps put some upward pressure on the credit cost. These two areas definitely is going to put pressure on the ROAs for the entire system. Private banks in particular had a phenomenal run over the last couple of years where the ROAs expanded significantly. We feel that now we are peaking out in terms of the ROAs. And from here, either the consolidation or moderation is going to happen. On the PSU side, to your question about it, our investor interaction suggests that the most comfortable area for the investor is the liquidity position, the loan-to-deposit ratio, etc., compared to the private banks. But given the fact that we have seen deposit rates go up even for them, it implies that the margin benefit may not be that significant. And historically, the experience on the margin management from the SOEs have been rather mixed. So we believe that the upside is limited. The stock is fairly well priced or reflecting the potential areas of excitement that investors may be having.
Right. Rahul, hi, good morning. Prashant here. The second reason that you mentioned, for I think on the private side, which you said, rise of alternatives. Do you mean money not going into bank deposits, but into things like equities, etc.? Is that what you mean?
Yes, not only equities, Prashant, but also even the government savings schemes, if you see, is having a good growth over the last couple of years. So there's a pressure building up all along.
Got it.
I would also like to quickly add one more point here. If you see the household balance sheets, the net financial assets to GDP has also been moderating. So if we combine these two pieces together, the banks will have to do a bit of a hard work out there.
Sorry, what is that ratio you're saying? Net, what has been moderating?
The net financial assets to GDP has also been moderating over the last couple of years.
I see. But sorry, shouldn't that rise with more allocation into financial assets?
Absolutely, it should. But if you see also on the other hand, the households are borrowing. So the growth, as we all see, unsecured loan growth has been pretty strong compared to the GDP growth.
Got it. Now, just to clarify the last point, for how much, because this is a hot topic, right? In terms of whether money which was earlier going into this banks, deposits, are going to equity, but specifically equities. Do you have any numbers? Have you looked at this over a period of time? What is that? Where is it at, and how has it changed over the years?
So we have that covered in our note for our investors, but there has been a significant shift. So if you see the stock of financial assets, the deposit share has been coming down. It has come off by a couple of percentage points. Even in the incremental savings on a yearly basis, the deposit share has been moderating. And it is actually well spread in other schemes also, apart from equity mutual funds. It's going to government savings schemes, it's going to insurance, it's going to even pension funds. So all of it put together is definitely posing more and more headwinds to the deposit growth for the banking system.
Okay, all right. Hi, Rahul. Good morning. Rahul, in FY24, we haven't seen any big divestment taking place in the government of India. But the hope is in the next couple of years that could very well be the case. And maybe there are a couple of large banking names which are in there, which could lead to some consolidation in the banking space. What's your view? How does it change the landscape?
Thanks, Nigel. Good question. If you see over the last couple of years, there has been a bit of a consolidation that's happening in terms of the market share, be it the deposits or credit. I guess your question is more around ownership. I'm also reading the same news article as you may have also read. The government also indicated that they are open to PSU reforms. So if indeed, if the government walks down that path, clearly, the investors would look into it. We did talk about it in our note that passive flows could start, coming their way. But nevertheless, we'll wait and see how the government responds to that over the course of next few quarters.
Can we just elaborate a little more on this rise in unsecured lending? Because you do mention in your note as well that you are a bit concerned about the asset quality of many of these banks because of the rising consumer leverage that may pose, some threat to asset quality in the near to medium term. Is this largely for PSU banks? Are you concerned about private banks as well? And which are the pockets that could get affected?
Thanks, Sonia. Good question. So the unsecured loan growth has been all across. Of course, there are various pockets. There are different consumer cohorts. There are ticket size cohorts, etc., where the growth has happened. So it's actually quite broad-based. But the market share shift has been actually more towards the private banks and the non-bank finance companies. So in our opinion, and going back to the third quarter earnings also, you did see some of the lenders did talk about increase in credit costs and normalization of credit costs in unsecured loans. So we have been monitoring certain data points, be it the high frequency bounce rates, be it the consumer, be it the portfolio behavior in different buckets. All of it is pointing towards some deterioration happening in the space. And that is going to lead to some increase in credit costs or reversal of interest income as the slippages go up. So it's going to be all across the space is what our assessment is.
Right. No. So banks we've spoken about. What about NBFCs? I mean, if you are downgrading banks, NBFCs are lower down the line, generally in terms of preference. So what's the view there?
So we actually have been also having a neutral view on NBFCs as well. The way we see it is, and basis our investor interaction, if private banks are going to have a liquidity problem, NBFC, of course, as you rightly said, is going to go down, going to be lower down the pecking order. So they will also be facing some headwinds out there. So we prefer themes where the funding costs can be passed on to the borrowers. And that means commercial retail segment looks better than the consumer retail segment. And by commercial retail, we believe loans given to individual and smaller businesses, which is having a good cycle at this point of time, versus the consumer lending where we are seeing signs of over-leveraging. So NBFCs who are catering to those segments should be better off than the ones in the consumer lending space.
Okay. Can you just help us with how the valuations of banks are stacked up now? Is there any valuation headroom? I get your concern on the fundamentals, but how are we looking at it from a valuation perspective, both PSUs and private?
Yeah. Thanks, Sonia. Again, a good question. So I think valuations have been in the comfortable zone, by and large, at an aggregate level. But within that, if you unwrap the covers, you will find that certain banks have derated a lot more than the others, and therefore the averages have been pulled down. And that's where I think we are advising investors to remain selective. Where the valuations are comfortable, the earnings are looking visible, I think investors would be better off there. So clearly, I think the valuation at an aggregate level looks okay, particularly for the private banks. But within that, you would need to pick and choose the names where the comfort would be there on earnings momentum as well as the downside protection and valuations. On the PSU banks, of course, we don't cover a whole lot, but the valuations have indeed moved higher. And now at these stages, we see the risk reward being balanced in that zone.
Okay, Rahul, good speaking to you. Thanks so much for joining in and sharing your thoughts on the banking as well as the financial space. Wishing you a good day ahead and looking forward to having a chat with you in the days to come.
Thank you, Nigel.
Well, time to slip into a short break. Up next, we'll connect with Mr. Sunil Reddy Dodla, the MD of Dodla Dairy, to discuss their business outlook. Stay with us. Welcome back. Well, the market's still holding well in the green. In fact, when we were having that chat with Rahul, actually, we went into the red and we have bounced back from there. So still holding at around 22,250. The high of the day was closer to around 22,300. At the start of trade, maybe a couple of people said, let's book out, let's go ahead with the weekend. For the time being, that trade has worked out. Take some money off the table. Well, Dodla Dairy, as promised, is the next management on our show. The company reported a decent set of numbers in Q3. Stock has been a big outperformer in the last 1 year or so. If you pull up a chart, you'll see it's doubled in the last 1 year. Well, recently, its board approved a capex of roughly around 10-12 crores odd. But to understand what's the trajectory going ahead, Mr. Sunil Reddy Dodla, the MD of Dodla Dairy, joins us on the show. Hi, Mr. Dodla. Good morning, and thanks so much for joining in. Well, you know, Amul has completed their 50 years. And they are stating that they want to hold on to their market share and be aggressive. And it's not a profit-making organization, right? There's not so much focus on profit. I recall when you chatted with us the last time around, you told us that in your markets, you have close to 7.5% market share. How do you compete in this sort of a challenging environment?
Good morning, Nigel. Thank you for getting me on your show. Mostly what happens is this competition has been something which we have been facing and fighting for the last 20 years or so. With the cooperatives on the one side, which are, they also go for profit, but the profit is distributed only to the farmer side and they look at the consumer as one. And for us, we also have to make financial profit. We do have our own set of market, which is around 30-35% of the markets are based for us. What we call them as our experimentals who have a preference for certain kind of milk products and they prefer to pick up. For example, they will pick up a company product for curd and maybe a company product for milk. And that's what we've been fighting for. Amul will have their segment. We will have our own segment. But more importantly, we're beginning to see a consolidation happening among companies. So I think that is where it's going to lead to. As much as Amul is going to be aggressively fighting for its market share, we will be fighting for our market share. And the consolidation will happen now that the smaller players will be weeded out.
Okay, the smaller players will be weeded out. Got it. Mr. Reddy, good morning and thanks for joining in. Can you help us with the metrics of the dairy industry currently? How is, the gross margins, the procurement prices, demand situation, and what's the outlook that you're looking at for the next 12 to 18 months?
Morning, Sonia. The outlook for the next 12 to 18 months, profits will be strong because the first quarter that we are looking at, what is the summer quarter, which is a good season for us. Compared to last year, this year our procurement prices are still lower. We're still getting good amount of milk coming into the system. We will be looking at good amount of profitability. Coming to growth in terms of the revenue growth will also be strong in terms of whatever we've been carrying on in the past year will continue going forward. Volume is something which we'll have to wait and watch because most of us had taken the pack sizes had come down to keep the prices stable in the earlier years. Now we'll have to wait and watch and see if we can increase the pack sizes to give the customers some relief in terms of the inflation that we had on the price of the product going up. If procurement prices continue to remain low, inventory buildups do happen. I think we will be passing on the benefit of additional profit to the consumers and we will maintain the same profit levels that we have been maintaining now.
Oh, that's interesting. So you'll maintain this 12 to 15% growth rate in Q4 as well, or would you want to scale it up? And for FY25, what are we looking at?
We will maintain the revenue growth of the 10 to 12%, Sonia, and FY25 also will be looking at the same growth rate of 12 to 12% in terms of revenue, because we also have other divisions that are kicking in. For example, our cattle feed division is kicking in a lot more. So milk on milk, we can look at the 10 to 12% growth rate, yes.
Okay.
Mr. Reddy, hi, good morning. Sorry, this is not so much a question about the company itself, right? But there was a news report which came yesterday, I think, which said that the Maharashtra FDA has actually sort of cracked down on one of the fast food outlets for using cheese substitutes. I think it's called analogous cheese, right? Yeah. Could you just explain this issue? And is this because value-added products in the dairy industry is a big growth area. That's where the margins are. Ghee, paneer, cheese, etc. Just wanted to understand this from you, sir.
So basically, analog cheese is nothing but replacement of milk fat with oils like a palm oil and to make become cheaper for the HoReCa sector or the consumer who prefers it. It will be more of labeling issues that we will face as we go forward. Basically, the dairy products in the country as of now are simple, clean dairy products. There is no additions. FSSAI keeps it plain and simple. When we go forward, as the country's economic growth is coming in, people are looking at various kinds of products. For example, higher protein, whether it's going to be only milk protein or added proteins that come into the play, will be where the challenge will come in value-added products. Because to create a higher value product with a higher margin, there is a lot of possibility of product R&D coming in by using replacements for more expensive ingredients. And I think customers have to be aware of the labeling and read the label before they consume it. That is going to be the most important thing that has to happen, because government laws are very rigid in terms of labeling. But after that, the customers have to be aware of what they read on the label before they consume.
Okay.
No, from a dairy company, from the industry perspective, is there any, the issue seems to be about labeling, as you said, but from an industry perspective, is there any impact at all?
Yeah, we are getting alternatives coming in, right? So we have to make sure our communication to the consumer that we are better than the alternatives, and therefore that communication has to improve from the company side.
Okay.
All right.
For
Mr.
example,
Durla,
you're using analog cheese versus regular cheese. How do I tell a consumer what the difference is?
No, because I mean the consumer who's going to these outlets would prefer. I mean, when it's cheese, they prefer cheese, right? And so that's the labeling issue that you're talking about as well. But in a way, this perhaps means greater competition, or is it? Because the alternatives would be cheaper, and that's why they're being used.
So, but that's where the value addition comes in. Like if you remember the ice cream war that happened, where we started saying, if you don't use milk products, Amul had gone to court and won at court, which said that you can't label ice cream if you're not using milk, and you'll have to call it frozen dessert. So now it's up to the consumer, will he prefer a cheaper frozen dessert or will he want a more expensive ice cream? And I think consumers will get the more expensive ice cream.
Okay, all right. Let's focus on another aspect then. A small part of the business, which is animal feed, but is growing. I think you mentioned the last time around that, capacity has gone up, I think 3 times, if I'm not mistaken. And you said that in the coming year, you'll see a far larger contribution coming from animal feed. I think right now it's just around 3% approximately. So could you tell us by FY25, what should you end at? I think this year you'll end closer to around, say, 80, 90 crores maybe. And on that, you're expecting to grow another 100 crores. So for the next year, you'll be closer to around 200 crores?
Yes, sir. Yes, Nigel, it will be 200 or a little more than 200 crores, because earlier we had a 2,000 ton capacity per month. Now we have expanded it to 12,000 ton capacity per month. And okay. I'm very confident that we'll do at least that.
So 200 crores, and what would be the utilization levels? I mean, how do you see this scaling up from there? It's still going to be a small part of your business, but tremendous growth potential, right?
Precisely. So I think we were earlier planning to get to our 12,000 ton capacity utilization over a period of 3 to 4 years. But I think right now, the way things are panning out, we should be able to reach almost 80% capacity utilization in the first 2.5 years itself.
Okay, all right. We'll leave it at that, sir. Thanks a lot for joining in and appreciate your time here on CNBC TV18. That's Dodla Dairy and the way forward for the business. Mahindra Lifespace Developers is the next one on the show. It reported a mixed set of Q3 numbers. The Q3 launches surged 51% and volumes gained by 8%. Amit Kumar Sinha, who's the MD and CEO of Mahindra Lifespaces, joins us now to talk about that. Mr. Sinha, thanks a lot for joining in. In FY23 as well as, in FY22, your launches were pretty high. But I want to understand, what is the pipeline looking like? What kind of launches are you looking at in Q4? In Q3, your new launches went up by 50%. Will this growth that you see in FY25 be driven by the new projects or the existing executions?
Thank you, Sonia, for having me. Q4 looking solid. We just launched our Kandivali project, which is called Mahindra Vista. And happy to share that in 3 days, we sold more than 800 crore of inventory that we put out. So very solid start to Q4. We hope to build on the momentum that we have seen the past quarters and conclude a very healthy FY20. So just to address your question specifically, the first 9 months we had done 5 launches. 2 were plotted launches and 3 were extension of previous project, new phases of previous projects. And they had limited inventory. But Mahindra Vista was the brand new launch in Kandivali, the healthy price point, great product, great set of sustainability and technology inclusions as part of the product. We expect some of the other big launches to happen in later part of Q4 or Q1, which will help us attain our targets that you just talked. A very healthy portfolio that's looking like for new launches. And we continue to mine our existing launches, the new phases of existing.
So 0.62 million square feet is the launches that you did in Q3, right? Can you tell us quarter by quarter what is the expectation in terms of numbers? How much will you do in Q4? And in FY25, what are you targeting?
The FY25, we have given a target of 2,500 crore pre-sales. And this is in addition to our IC business. So I'm just talking about the residential business, 2,500. But as we have explained, our desire to grow our business 5 times, we have been designated as a growth gem by Mahindra Group at M&M level. We have improved our aspiration to be 5 times in 5 years, so 8 to 10,000 crore in by FY28. While we have given the short-term target of 2,500 crore, our goal is to start to change the momentum from the next financial year, FY25. So hopefully it'll be an exciting year to look out for. As we brought a lot of changes in the current financial year, the impact is only going to be visible in the next financial year. And Q4, I think you can do a simple straight line between what we saw FY23 and what we are hoping to achieve in FY25, and hopefully we will beat that straight line.
Okay, all right. Hi, Amit. Good morning. Good to see you in. Nigel on this side. You know, if you just drive down, you'll see the kind of redevelopment that's taking place here in Mumbai. And y'all have got a couple of projects, I think, in Santa Cruz as well as in Malad. As a percentage of total business, how much is redevelopment? And tell us how you see things panning out here.
Yes, great question, Nigel. You're absolutely right. We are seeing a huge amount of momentum on the redevelopment side, society redevelopment side. And given the trust our brand enjoys, we continue to get a large number of inbounds to participate in those projects. But we are careful and thoughtful about the financial side as well as what kind of product we can deliver to redevelopment opportunities. Of our portfolio today, roughly 15% or 20% is, from a GDP perspective, is likely to come from redevelopment. We're going to maintain that healthy balance. As you see, we are focused on just 3 major cities for the time being: Mumbai, Pune, and Bangalore. Pune and Bangalore are where you can do outright land purchases. But in Mumbai, given the land prices, we deploy outright, which is a small percentage, joint development, which is a large one, and society redevelopment. My sense as we see, as we look forward, a sense is roughly 50% would be joint development, 20 to 25% would be outright, which will be in the broader MMR area, and 25 to 30% would be society redevelopment.
Okay, so specifically on the launch in Kandivali, can you tell us how much inventory are you bringing to the market in the first phase? And across whatever other launches that you have planned for this quarter and maybe the first half of next year, what's the cumulative GDV that you're looking at for all of these launches?
Yeah. So Kandivali is a largest project for us. One of the, I would say, the inventory that we brought in is 600 units, so north of 1,000 crore. That's been brought in phase 1. The total inventory across phase 1, which has been brought in, and phase 2, which will bring in a few months from now, would be north of 2,500 crore. So that's the Kandivali project. The pipeline that we have, which is awaiting approval at different stages, including the RERA approvals that are almost about to come through, is a total GDV inventory is roughly 5,000 crore, which is the BD pipeline that we always maintain. There are some additions and subtractions that happen. I'm also excluding the Thane land parcel, which is roughly 8,000 crore GDV, because we have to get additional approvals for that large parcel of land to be ready for a new launch.
Okay, all right. Amit, you know, your shareholders will be very happy with what all you're saying, right? Things are looking up. You're sounding very, very optimistic, you know, but I'm a little bit worried about this entire redevelopment that's taking place. I hope infrastructure and hope everything is enough, you know, to support this sort of supply that's going to be coming in there as well. But be that as it may, let's focus on pricing. If demand is so strong, do you think you can push through further price increases and push my dream of a larger house a little further? What's your take out there?
Yeah, no, I think you're absolutely right, Nigel. And it's a longer discussion to think about is the urban infrastructure is going to catch up with the demand that we see in the metropolitan areas. So I absolutely agree with you. And I moved from Gurgaon to Mumbai, so I've seen the constraints and challenges of both the cities, to say the least. But you're right, the price increase, there's a huge amount of demand. Post-COVID, we saw a huge amount of interest in owning a home, upgrading a home, and buying a bigger home. So all those things are very, very favorable. And the counter side is the inflation also has been not kind to all of us. But we see roughly 8 to 10% increase in pricing year on year in FY24 or F23. So it's allowing us to increase our margins to at least cover the escalation that we see on the commodity side, on the wage side. So at least we protect our margins. But the challenge of urban infrastructure will continue. Hopefully, you have the opportunity to see Mahindra Vista and some of the new launches. It will get you closer to your dream home aspiration, and it's designed really well. I'll request all of you to look at that.
Okay, all right, Amit. Been a good chat with you. Thanks so much for stopping by and filling us in with all of those details. Wishing you all the best. And it seems it's good times for the real estate sector, and Mahindra Lifespace Developers is definitely participating in that as well. Well, the markets are holding well in the green. And the stock that's really catching my attention is Jio Financial Services. Just take a look at that stock. Big up move is what we are seeing. It's up close to around 10% as we speak. It's up 22% in this week. And also in this month, it's up close to around 33%. So that's the biggest mover. And Vodafone Idea as well is moving up on rather large volumes. For the time being, we'll slip into a short break. You come back. Mitesh Thakkar will be back with us. He'll give us some trading strategies, and we'll also address a couple of the stock movers.
Welcome back. Well, Mitesh Thakkar is joining in now to tell us how to approach the markets from here on. It's actually a very good day. Look at the broader markets. The mid-caps are up 220 points and lots of stocks moving around. Mitesh, what do you do for the rest of the day? Where do you see some opportunities now?
So, it's a market which is enjoying good breadth, though I think the Nifty gains are slightly limited. But I would still bet on the long side. Persistent system has come on the radar. I think IT was already in the focus. That's open with a gap up, so that's a buy. Keep a stop loss here below the levels of 86.20 and a target of 8900 can be looked at. And the other one is Indus Tower, which with the disclaimer that I have some stock in my portfolio. So Indus Tower, I think, also opened with a gap up. That's a buy with a stop at 228 for a trading target of 245.
Got it. Okay, all right. Thanks a lot for that. Mitesh, well, let's focus on a couple of stocks that are moving around, and some are reacting to FTSE, the changes that they've announced, and they announced some revisions to the semi-annual index review, and these changes will be effective from March 15, 2024. Let's run you through the FTSE all-world index changes first up. In the FTSE, they've rolled back the deletion on embassy office parks rates, and so that will stay in the index. That's why that stock has popped up now. It's going to be maintained. It's going to be retained, so up closer on 3%. But they've rolled back the addition on fact. Explains why fact, after the hope that it's going to get added, and now it's not going to be added. So that's why fact is under some pressure today. The other changes in the FTSE all-cap index include the fresh additions, and the stocks are reacting, so we should get some of them up for you on the screen. Gokuldas Exports, Voltam, you have CMS Info Systems, Archin Chemicals, as well as Bank of Maharashtra, Hudco, and Lloyds Metals. All of them, they are additions, and that's why most of the stocks are doing well. While some additions, they have been rolled back, and those stocks are reacting negatively. You have Orient Cement that's under some pressure. Relige Enterprises as well has seen a bit of a knock, and there are a couple of deletions that have been rolled back. Case in point being a Nexus Select Trust. So that stock, I think, is reacting positively. But let's get in Dreama to talk about the stock that's buzzing big time today. Before that, let's hear out the Aditya Birla Group chairman, Mr. Kumar Mangalam Birla. He said that the company is looking for a partner in Vodafone Idea. Let's hear out what he had to say, and then Dreama will bring us an analysis.
We remain very committed to Vodafone, and like we've said in public domain, efforts are on to get outside investors. And I don't know what's prompting your question. I think we remain as committed to it as we have been in the past.
Okay, so that's Kumar Mangalam Birla, very confident that they could get a partner on board, and they remain committed with Vodafone Idea. That's the reason the stock is up 9%. There's a board meeting as well at the end of this month. There are fundraising plans. Reema's here to tell us more about that. Reema, over to you.
Thanks so much for that. So 8% higher on Vodafone Idea today. The month-to-date rally now stands at more than 20%. And this is a stock which has seen a 165% rally in the last 1 year. So from its 52-week low, which took place on 31st of March 2023, the stock is up quite a bit. 5.7 rupees was the 52-week low. There is a board meeting, as you rightly pointed out, next week on the 27th of February, where they will consider a fundraise. Now, the key is going to be the quantum of fundraise. The company has been unsuccessful in the past to raise some money. So how much they raise is going to be key, because that will determine their deleveraging, because debt on the books is in excess of 2 lakh crore rupees, and also their 5G foray and the kind of investments they can make. Now, Citi says if it's done via rights issue, because right now all options are on the table based on what the company's BSE announcement says. It could be rights issue, pref issue, QIP. If it's a rights issue, then the promoter participation will be the key. And in the past, Kumar Mangalam Birla has also indicated that 2,000 crore is what they're willing to pump in. A successful fundraise will be positive for Indus, while if they raise a very large amount, it could weigh on Bharti Airtel and its peers. Back to you.
Okay, thanks a lot for that. Well, let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Samiran Chakraborty, the chief economist at Citi, to discuss what he's made of the minutes of the last monetary policy meeting. Stay tuned.
Welcome to It's the Economy. The minutes of Reserve Bank's Monetary Policy Committee indicate that a majority of the MPC members believe any policy easing should start only when inflation sustainably moves towards the 4% mark. However, one external member, J.R. Verma, told CNBC-TV18 that if GDP growth is calculated from the pre-COVID year, to FY24, it works out to just 4.5% compounded annual. And that, with an inflation forecast of 4.5% for next year, a repo rate now of 6.5% is 2 percentage points of real rate. He thinks it is way too restrictive. That was the dissenting vote. Now, Citibank's economist, Samiran Chakraborty, writing a report a week before the MPC, also argued that urban consumption is actually weakening in India, and hence the Reserve Bank must consider easing its monetary policy to support growth. Today, I have the man himself, Samiran Chakraborty, Chief Economist, Citi India. Samiran, first, the MPC, what are your key takeaways from the MPC minutes? Do you detect any sign at all of early easing of rates?
I don't think so. I think the majority of the MPC is quite clear on what they're doing. They're very clear that the last mile of disinflation is always very challenging in this kind of a global environment where the markets are kind of running ahead of the policymakers. They're worried that any sign of softening of policy and markets could really, the yields could fall. The other aspect that they're looking at is that they don't want a situation where they cut rates and then they have to use the MPC's word, backpedal themselves. Another issue is that they want some clarity on whether weather-related shocks, they've seen through it, because while core inflation is down, there is pressure on food inflation. So because of these multiple reasons, and most of the MPC members seem to be believing that growth numbers are still quite strong. So there is no urgency in doing the rate cut. So I suspect that because of all these reasons, they will probably want to stay on course to deliver the 4% headline inflation result, see it staying in the system for a while before we can consider rate cuts.
Fair enough. So when are you expecting the first rate cut? Have you changed your mind after the MPC minutes?
After the February policy itself, we had changed our view to some extent. Earlier, we were thinking that maybe an August rate cut preceded by a policy change somewhere in June is possible. Now we think that they get pushed back by one more policy. So the first rate cut probably is not before October. But, this is so far out that a lot of things can change before that. Particularly, we'll have to wait and see whether there is undershooting of growth compared to RBI's expectations, or there is overshooting of inflation compared to our RBI's expectation. It can be in both sides, but depending upon that, the timeline could also shift.
Okay, fair enough. Samiran, now let me come to your very interesting report that you gave a few days back. Why are you arguing that Reserve Bank has to support growth with policy easing measures?
So a basic premise is that historically, we don't see a very good direct correlation between output gap and core inflation. Output gap is simply put the excess GDP growth over the country's potential growth. There could be many reasons for it, but what we find is that if we divide the output gap in what is causing the output gap, whether it is the investment side of the economy or the consumption side of the economy, we find that if output gap is being caused by higher consumption, then core inflation reacts more and substantially more, whereas with investment, sometimes it could be even negative. Higher investments could actually lead to lower core inflation. And within consumption, we find that between the urban consumption indicators versus the rural consumption indicators, it's the urban consumption indicators which have a predominant effect on core inflation. And what we observe over the last 6 odd months is that the urban index, albeit from very elevated levels, is coming off, and the core inflation is following that. Today, the core inflation momentum is at its weakest in the series from the time the series is kind of started. So it's a sense that we get that the demand slowdown is feeding onto core inflation. But I must say that it's difficult to differentiate between how much is due to demand slowdown versus how much is due to commodity prices decline, a lagged effect of that.
No, that is the point, actually. I've heard quite a few experts argue that low core inflation is because of disinflationary trends caused by the Chinese economy. You still think it is India's low core inflation is because of domestic urban consumption slowing?
So, I mean, as I said, that it's often difficult to differentiate accurately on this with multiple data issues. In fact, we have to take out housing from the core inflation numbers because housing would always create that distortion in the data with pay commission related impact on housing, etc. So, but if you look at even the services part of core inflation, which is non-tradable, should not have any impact of input prices, even that is significantly highly correlated with urban consumption rather than anything else. So, and that's also has been weakening. And in the Indian context, it's reverse to what we see globally. Globally, it is the goods inflation which has collapsed, but services inflation has been sticky. In India, services inflation has been lower than goods inflation for a while now. So even that's a very proxy way of looking at trying to differentiate between the global disinflation argument versus the domestic demand argument.
No, actually, if you look at PMI for manufacturing and services, both even in February have come in strong for the last 4 months. What exactly are you finding weakening in urban consumption?
This is a composite indicator that we have, so a lot of things goes into it. But I think the main challenge that is happening is that the urban employment growth at the top end probably is tapering off a bit. And in line with that, the urban wage growth indicator that we have from wage cost of about 3,500 listed companies, that is also coming off. And both these things are turning out to be headwinds. Along with that, the excess savings during the pandemic that the consumers had, that is also now mostly exhausted. So all these factors, along with possibly, this has probably not yet happened, but going forward, and another additional headwind could be any slowdown in consumer credit as well, based out of the current situations. Now, I must also say that while I'm saying it is slowing down, I'm not saying it is collapsing. The growth rate is still in our index marginally ahead of the pre-COVID growth rate. And it's still ahead of the rural consumption. So there is nothing to really worry on that front. It's just that directionally, this is matching with the direction of core inflation.
Oh, okay. Still higher than pre-COVID. That's important. Now, is this slowing urban consumption impinging on your GDP growth forecast? What is your take on GDP growth in FY24, the last 2 quarters, and in FY25? Have you changed it recently?
We are working with about 7% growth in FY24 and 6.5% growth in FY25. So marginally ahead of the government or RBI, marginally lower than the government and RBI forecast. And that's where we have tried to build this in. We will have probably the GDP data very soon for the December quarter. We'll get a sense of whether that data itself is picking up this sort of high frequency data nuances in the December quarter itself. We are working with a 6.7 kind of a number for that quarter, marginally lower than, again, RBI's estimate of 7%.
Got it. Okay, now to come to another point, the US growth is actually surprising on the upside. In that economy, CPI has also been higher, and that is pushing up yields. Will this, US yield impinge on Reserve Bank's thinking of monetary policy, impinge on its action?
First, I guess the City's house view is that the US economy will go into recession in the middle of the year. Global growth forecast for City is only at 2%, and that can feed into the India growth numbers. We have tried to factor that in, and my sense is that even if the main issue would be that if global growth actually surprises on the upside, then some of the headwinds that I was talking of, these headwinds might not be there. I mean, the employment growth situation in India might change substantially if the world economy grows faster. We could have more drivers of growth, and that might mean that RBI pushes back the rate cut expectations even further out. And if we are really unlucky, then the China growth story picks up, leading to more global inflationary pressures. And that could mean that the whole inflation forecast might also have to be looked at. So at this moment, those uncertainties the MPC will have to deal with.
Well, let me put another uncertainty on the table. Can Reserve Bank and MPC find themselves in a peculiar dilemma that core CPI keeps falling, but food CPI remains high, because of erratic monsoon or whatever? Then how will RBI answer this? Will they respond to core CPI or will they refrain?
Well, in a smaller way, the dilemma is already in front of us.
Yes.
Food inflation is running at almost double the pace of core inflation at this point of time. But I guess the way the majority of the MPC is constructing their hypothesis, it appears that the 4% inflation target is very sacrosanct, and partly because of one of the MPC members clearly articulated that it doesn't matter where the inflation is coming from. As long as the inflation is there, it's actually hurting consumption demand. It's hurting the purchasing power of the consumer. So to that extent, we now need to bring that inflation down to that 4% to rekindle consumer demand to some extent. I think that's why the RBI cannot just say that the decline in core inflation is good enough for them to go ahead with rate cuts. At least that's the sense that I get currently.
Yeah. We are flashing Michael Patra's comment, exactly what you're saying, that consumption is actually falling because of high inflation. Therefore, you have to bring inflation under control for growth. Okay, now a final question on bond yields. Indian bond yields, now the Reserve Bank has started giving money via repos, almost 3 lakh crore as of date, and the call rate has started falling towards 6.5%. Now, foreign debt flows have been excellent over the last 6 months. So what is your yield forecast for FY25?
Back a little bit our forecast of when the bond yields will start to come off, because ultimately the markets will have to get the comfort that RBI is okay with easing of some monetary policy stance. And that's where the market will be first looking at the change in stance when it comes. I think that will be the big trigger point for bond yields to start drifting down. Otherwise, let's say hypothetically, we are in a situation where RBI is not considering any stance change or rate cut. Then even if we get these bond index inclusion related flows, we are most likely to neutralize those flows, sterilize those flows through OMO sales, etc., and not let the bond yield strip. But we think that by end of FY25, we'll be heading towards a 6.5 kind of 10-year bond yield. The shorter run, it's more range bound till we get more clarity on when the monetary policy easing actually starts.
Okay. Oh, got that. So the Reserve Bank can play spoil sport, but 6.5 is something. I've heard 6.75, not 6.5. That's a big positive from this conversation. Thank you very much, Samir Chakrabarti, for joining us. With that, we have to wrap up on Bazaar after break. It's time for Chartbusters.